Imagine this for a second. The internet is still on, but it's unstable. Markets are open, but frozen. Your crypto wallet shows a balance, but withdrawals are paused. Not because your coin went to zero, but because the system around it stopped moving. You refresh the screen again and again. The number is still there. Your wealth technically exists. But it is unreachable. Now look outside. Fuel is scarce. Stores limit purchases. Repairs take weeks instead of hours. In that moment, the question changes. It is no longer how much you own. It is what you can actually use. Crypto was designed to escape banks, but it was never designed to escape reality. It still needs electricity, internet, infrastructure, social order. And when those become unstable, digital ownership turns into delayed ownership. This is the blind spot most crypto investors never confront. They prepare for volatility, not disruption. They prepare for price drops, not access failure. And history shows us something uncomfortable. In real stress scenarios, access matters more than valuation. Utility matters more than ideology. And the asset that wins is never the one people argued about online. It is the one people quietly depended on offline. When people hear bigger than crypto, they assume market cap. They assume price. They assume returns. That is the wrong frame. Bigger does not mean louder. Bigger means deeper. Crypto is powerful, but it exists on the surface layer of the system. It moves fast. It reacts fast. And it breaks fast when conditions change. The asset category we are talking about sits underneath everything. It does not care about narratives. It does not need adoption curves. It does not wait for regulation to be friendly. It is already embedded into how the world functions. It is used whether markets are bullish or terrified. It is consumed whether currencies rise or collapse. And unlike crypto, it does not compete with trust. It competes with necessity. This is why governments do not debate its importance. They secure it. This is why supply chains are built around it. This is why when inflation hits, its value adjusts instead of eroding. Most people ignore it because it feels unexciting. It does not promise 10 times returns. It promises continuity. And continuity is boring until it becomes priceless. The mistake is assuming the most important asset of the next decade will look futuristic. History shows the opposite. The most important assets are the ones civilization cannot function without, even when everything else fails. Smart money does not panic when an asset becomes popular. It starts asking what comes after. Crypto had its moment because it solved a specific problem. It removed intermediaries. It digitized trust. It moved value faster than traditional systems. But once an asset becomes widely understood, its asymmetry fades. Returns compress. Risks become obvious. And capital begins looking for the next layer of protection, not excitement. This is where most retail investors get stuck. They anchor emotionally to the asset that changed their worldview. They confuse innovation with permanence, but smart money separates the two. Innovation creates opportunity. Permanence preserves wealth. After every innovation cycle, capital rotates toward what supports the real economy underneath the innovation. This is not theory. This is pattern recognition. After the dot-com boom, capital flowed into infrastructure, energy, and hard assets. After financial crises, it flowed into things that could not be diluted or digitally paused. The key insight is this: smart money does not ask what asset will outperform in perfect conditions. It asks what asset will still matter when conditions are imperfect. Crypto thrives when systems are stable enough to allow experimentation. But when systems tighten, capital looks for assets that reduce dependency, not increase it. That shift is already happening quietly, without headlines, without hype, and without permission. The secret asset bigger than crypto is not a single ticker. It is a category most people misunderstand, Because they evaluate it using financial logic instead of survival logic. This category is not designed to multiply quickly. It is designed to anchor value when systems strain. It exists outside screens, outside platforms, outside algorithmic control. It is tangible, productive, and deeply integrated into civilization itself. It is what turns raw resources into usable life. It is what keeps economies functioning, even when currencies wobble. This category benefits from inflation because replacement costs rise. It benefits from scarcity because supply cannot be instantly expanded. And it benefits from chaos because demand does not disappear when markets close. This is why people who truly understand risk exposure never rely solely on abstract assets. They balance them with assets that do not need interpretation to be valuable. You do not need belief to use them. You do not need adoption for them to matter. You do not need permission to benefit from them. And that is why this category quietly outlasts every hype cycle. While others debate price action, this asset category quietly compounds relevance. And relevance is the most underestimated form of value there is. Most investors miss this asset category, not because it is hidden, but because it feels too ordinary. Modern investing trains people to look for symbols, not systems. Tickers, charts, narratives, and forecasts dominate attention. Anything that does not move fast enough is dismissed as dead money. Anything that does not sound futuristic is ignored. This is why people chase volatility instead of durability. But history shows that durability is what decides who survives long cycles. The investors who lose the most are not the reckless ones. They are the overconfident ones, the ones who believe diversification across abstract assets is protection. In reality, when stress hits the system, correlations rise, liquidity disappears, and assets that looked different on paper start behaving the same. This is where most portfolios fail. They are diversified financially, but not functionally. They own many things that depend on the same fragile conditions: stable power, stable networks, stable regulation, stable trust. When one pillar weakens, everything trembles together. The asset category we are talking about does not share that weakness. It functions even when coordination fails. It creates value without asking permission. And because it does not fit neatly into modern portfolio models, it is systematically underweighted. Not because it lacks importance, but because it lacks excitement. And excitement has become the filter through which most people make financial decisions. Here is the question that changes everything. If tomorrow the system became slower, more expensive, and less reliable, which of your assets would become more valuable, not less? Which of them would be demanded immediately without explanation? Which of them would people trade real goods and services for? This question cuts through theory and forces honesty. It reveals the difference between assets that exist on balance sheets and assets that exist in the real world. The secret asset bigger than crypto is not about replacing digital innovation. It is about anchoring it. It sits beneath technology, beneath markets, beneath financial engineering. It is part of the physical and social infrastructure that allows everything else to operate. When systems tighten, this category becomes more visible. When supply chains strain, its importance multiplies. When inflation rises, its replacement cost forces repricing. This is why smart capital moves into it quietly, early, and without drama. Not because it expects explosive returns, but because it understands asymmetric protection. And once you see that distinction, you realize something uncomfortable. The biggest risk is not missing the next crypto rally. The biggest risk is being fully exposed to assets that only work when everything works. By now, you can probably feel the shape of this asset, even if you cannot name it yet. That is intentional. Because once you strip away branding, price charts, and online debates, only one category fits everything we have described. It is not digital, but it supports digital systems. It is not financial, but finance collapses without it. It is not speculative, but demand for it never disappears. This asset does not wait for adoption. It is already required. It is embedded into energy, infrastructure, food systems, manufacturing, logistics, and defense. When technology advances, it becomes more valuable. When supply chains fracture, it becomes more valuable. When inflation rises, it becomes more valuable. And when stability breaks, it becomes critical. This is why governments secure it quietly instead of promoting it publicly. This is why disruptions around it cause panic even when markets are calm. And this is why people who truly understand systemic risk never treat it as optional. They treat it as foundational. The reason most people struggle to see it is because it does not behave like an investment. It behaves like a requirement, and requirements do not need hype. They only need scarcity and necessity. Crypto is powerful because it changes how value moves. This asset is powerful because it determines whether value can move at all. Crypto lives on top of systems. This asset is part of the system itself. You can have crypto without stability, but you cannot have stability without this asset. That is what makes it bigger. Not in market capitalization, not in returns, but in consequence. When crypto fails, portfolios suffer. When this asset fails, societies suffer, and that difference matters. This is why, during every major global disruption, attention eventually shifts away from abstract wealth and toward real capacity. Who can produce? Who can repair? Who can power? Who can sustain? This asset sits at the center of those questions. It does not promise freedom from the system. It enables the system to exist. And that is the inversion most people miss. They look for assets that escape dependency. Smart capital looks for assets that create dependency. Because when everyone depends on something, it cannot be ignored, suppressed, or replaced easily. That is why this asset does not need belief cycles. It does not need community consensus. It is demanded by reality itself. And reality is the only thing that never goes out of style. Here is the uncomfortable truth. Most people will realize the importance of this asset only after it becomes obvious. After shortages, after price repricing, after headlines catch up to reality. By then, the advantage will be gone. This is not about abandoning crypto or technology. It is about understanding layers. Digital assets sit on top. Real assets hold everything up. The smartest strategy is not choosing one side. It is knowing which layer you are exposed to. So take a moment and look at your positioning. Ask yourself, which of your assets depend on belief and which depend on necessity? Which of them require everything to work? And which of them matter most when things do not? If this perspective shifted how you think about value, inflation, and risk, then you already understand why this asset is bigger than crypto. If you want more breakdowns like this, grounded in history, systems, and reality instead of hype, make sure you subscribe and share your thoughts in the comments. Because the smartest moves are rarely exciting in the moment. They only feel obvious in hindsight